Welcome back to the Commercial Real Estate Show. I'm Michael Bull. Today we're talking about the multifamily sector. Please welcome my next guest, Stephen Marks. He's Managing Director with Fitch Ratings. Stephen, thanks for joining us today.
Michael, thank you very much for having me.
Well, we appreciate it. And my first question for you, Stephen, is how did multifamily REITs perform in 2014 compared to other REITs and to the market in general?
Sure. The multifamily REITs did great. Over the last 12 months, the multifamily REIT index was up roughly 50%. That compares to the broader U.S. equity REIT index of being up roughly about 37%, and the S&P 500 was sort of in the low single digits. And the multifamily REITs were the best equity performers in the REIT space other than manufactured homes.
Wow. And so what is your outlook for REITs and multifamily REITs moving forward?
Sure. We have a stable rating outlook for REITs heading into 2015 and a positive sector outlook. And so it's two different things. The stable rating outlook is based on a couple of drivers. One is that we continue to expect continued solid liquidity in terms of access to capital across the capital stack. We do envision that there's going to be improving property-level fundamentals across nearly all asset classes. And lastly, we think that REITs are going to continue to embrace lower-risk strategies in terms of how they fund their development and how they do development generally. Some of those positive elements are balanced by a couple things. One is relatively unchanged leverage, a continued slow economic recovery, and some concerns about interest rates. Now that's the rating outlook. The sector outlook we actually bumped up to positive for a couple things, and a lot of these we think are secular changes that are happening within the REIT sector, coming out of the recession in 2009, 2010, and namely these are things such as stronger, tighter portfolio focus, lower risk growth strategies, as I mentioned before, in terms of development, really good liquidity management. We don't see there being a lot of share repurchase risk in the sector. And in general, we think that companies are going to continue to focus on having strong credit quality.
Okay, and we're talking with Stephen Marks, Managing Director with Fitch Ratings. And Stephen, what are some things that investors should think about today?
Well, for sure, when it relates to the multifamily sector, we do have a couple things that we think are important to think about. Some of the major themes. I think the first thing is that there are some supply concerns in some specific markets. In fact, our expectations are that 2015 deliveries represent roughly 2% of total nationwide stock. That compares to about 1.3 average over the last 15 years. So there's going to be more supply coming online over the next year or two, and in particular markets such as Denver, Nashville, Seattle, and Boston are markets where those deliveries are going to be above averages, and that is a concern, certainly supply. And I think the second thing is there is an interplay, and there are certainly some shifting sands between home ownership and renting. It's our view that it is somewhat of a zero-sum game. That I think some folks have a view that as home ownership increases, that strengthens the economy and that helps multifamily as well. Our view is that we don't believe that. So not quite a zero-sum game, but any loss in home ownership benefits the multifamily sector disproportionately.
Well, that would make sense because you think at some point the single-family home market will stabilize, and then you'll have your occupancy in your apartments. And then if you do have people who are renting to buy homes, it's not like you're going to have a big surge in jobs. That seems to make sense.
Yeah, we think so. And there's also a broader secular shift happening. Folks are getting married later. They're having babies later. They need houses later in life, and we think that's going to put a brake to some degree on any growth in home ownership. Certainly a lot of folks coming out of college have student loans. It's harder for them to sort of meet some of the credit standards in order to obtain a home mortgage, and all that certainly does benefit multifamily.
Right. And so that's some of the factors there that are just going to keep occupancy and rates continue to go strong. But so your only concern is maybe in some of these cities where they're building a lot of new supply.
That's exactly right. And to REIT's credit, I think a lot of them recognize and acknowledge that there was a supply wave coming, and so many of them have actually toned down their development pipelines, and their goal was to wrap up a lot of their development by 2015 and heading into 2016 because they just didn't want to compete with a lot of the merchant builders and some of the dedicated developers out there.
Okay. And what role has Fannie and Freddie played in the financing in multifamily?
Well, certainly Fannie and Freddie are big players in the sector, and it's our view that multifamily REITs' ability to have higher leverage certainly provides them with the ability to have stronger ratings because there's effectively a backstop, if you will, given the liquidity provided by the GSEs. And should that backstop change in some sense, we would certainly consider how we think about the multifamily REITs from a credit standpoint. But more broadly, how we do think about the GSEs is that we did expect that there would be a reduction in originations and a shrinking balance sheet, but what happened during 2014 was that didn't happen, and the FHFA Director Melvin Watt in some ways de-emphasized some of his predecessor's goals, namely shrinking multifamily exposure. So we don't envision there being a significant pullback by the GSEs in terms of their dedication and their commitment to the multifamily sector anytime soon. Certainly it is somewhat of a political issue, and these things tend to take place on a protracted timetable.
Okay. And talk to us a little bit more about interest rates and their impact possibly on the multifamily market moving forward.
It could cut a couple ways. If an increase in interest rates is driven by a strengthening economy, growth in employment, then hence that would probably drive household formation. That would certainly be good for multifamily. If interest rates were to increase in somewhat of a spike scenario, that would be bad, given that multifamily has the shortest lease terms in the REIT space, and those rents would probably react more quickly and more negatively. That's on the fundamental side, and then on the valuation side, there's two elements of it. There's the valuation of the assets, and there's the valuations of the stocks. On the asset side, typically cap rates increase when interest rates increase, and if cap rates increase more quickly than interest rates increase, that could be more of a concern. Or in particular, cap rates increase more quickly than underlying cash flows increase, that would cause a reduction in value. But there is a cushion. If you look at cap rates, the difference between cap rates and interest rates, there's a substantial cushion right now, so we don't envision that cap rates and interest rates would increase in lockstep. And then on the equity side, there has been shown to be a correlation between interest rates and REIT equity returns. As interest rates go up, equity returns tend to go down. The mitigant to that is that there is a wall of capital continuing to chase yield. REITs are a yield product, and so we don't envision there being a substantial pullback on the equity side, even if rates do increase.
Yeah, well, that makes sense. Well, what are some quick tips for investors who are considering investing in REITs? What are some of the things that they should look at?
Well, certainly it kind of ties back to how we think about the outlook from a credit standpoint, is that folks probably need to consider companies' risk appetites. Are they willing to do speculative development? Are they willing to buy back stock? Generally, I think there have been a lot of studies that have shown that lower levered REITs tend to perform better. Companies with lower development pipelines tend to perform better over time, which is somewhat counterintuitive, because one would think that to the extent that companies were to use leverage on an asset class like real estate, that would result in higher equity returns. But in fact, it's been just the opposite. The equity market really seems to like companies that are lower levered, and certainly as a credit guy following REITs from that perspective, we view certainly lower leverage and lower risk strategies more positively.
Okay. Well, Stephen, thanks for joining us today. We appreciate you being on the show.
Great, Michael. Thank you very much for having me.
And for more information, visit FitchRatings.com. This is Michael Bull. This is the Commercial Real Estate Show. Stay with us. We'll have more on the multifamily market.